Okay, so welcome again. In this case, we have the honor of having on Brennan Worth. Brennan Worth is the co-founder and CTO of Substrate AI, senior software engineering with over 10 years of experience, has spent over 5 years in the development of advanced reinforcement learning algorithms. Features of this work include automatic temporal abstraction, hierarchical, state learning, adaptive look ahead, and a top-down effective model of cognition. He actually, this company, Substrate AI, is a company with many projects ongoing, and one of them in particular is, it has to do with investments. So this is the reason, and actually in the club, in Zonavalue Club, so we use his models to build strategies. So it's really, in this case, this presentation, for me, it's really interesting since we are going to see the power of the AI used in the investment side of things. And actually, it's a theme that now it's growing a lot. What I see is that the hedge funds, the mutual funds, etc. So all of them, people is trying to put together the traditional way of investing plus AI. So this is something that we can, we have to, in this case, we have to learn a little bit more, and we have to make sure that we understand what's going on in the industry. So Bren, hello. How you doing?
Hi, doing good. It's a pleasure being here.
Excellent, excellent. Okay, so I'm going to give you a pass so you can start the presentation, and then we will go through questions and answers, okay?
Sounds great. Let me kick off the presentation here. Or actually, probably need to first share my screen.
Here we go.
Okay.
Okay, so go ahead.
Thanks. So yes, I'm one of the co-founders and CTO of Substrate AI. We're an Austin-based startup back in 2016. We partnered with Zonavalue not too long after, and we've been working these past few years actually kind of refining and developing an algorithm that was good for retailers and for, kind of like industrial or, commercial related trading operations. Our algorithm has been trading for the past 3 years with very solid returns. Numbers in the back test or forward test are kind of meaningless, but we've been trading on collective 2 for the past year and change, and we've easily gotten nearly 40% returns just this year alone. And that's including, of course, the pandemic. So it's kind of exciting to see that. And we're also collaborating with savers on a new fund. So it's kind of exciting. Kind of like my one slide history of algorithms and trading, and it's really fast. So, you have the market. People want to, use the market to get rich without having to work. Algorithms, were used to, get us there. In the early days, it was much easier than it is nowadays. There's basically as many algorithms as there are people in the world, and I think actually many, many more. In terms of, kind of like performance metrics, I like to use Jim Simmons from Renaissance Technology, who's done nearly netted 40% for 30 years. And that's truly an awesome statistic and, a great kind of goal to hit. So you want to trade with AI. It's fantastic. It's, kind of the thing to do nowadays. And to be quite honest, I think they're going to be seeing a lot more AI and a lot less people. But you have to kind of like think about things that you want to do or how you want to do it. Because we kind of went at it piecemeal, didn't have like kind of like a real vision as to how this should all look, and kind of learned iteratively as we developed this trading system. But some of the things we've seen is, what kind of time scale do you want to trade at? What kind of algorithms do you have comfortable usage of? Technical skills to use. What kind of data? Of course, you can't have algorithms without data. And what is your, technical skills of being able to execute this whole thing together? Okay. So time scale and trading can affect the kind of algorithms you use. Okay. So high frequency trading uses very specific like ML, like no deep learning. Okay. It's way too slow. Okay. Because you're hitting millisecond, sub-millisecond time scales. It also has very different, costs for data. So high frequency data for trading, you have to be basically right next to the exchanges. This also increases the amount of cost in infrastructure, which is millions and billions of dollars. And timescale also affects the kind of risks you can be impacting. So day trading has much higher risk than long-term trading. Okay, so especially if you're just entering this, you probably want to go slow. Okay, and this also kind of impacts the kind of algorithms. So deep learning can be applied to a longer-term trading, deep learning as well, or day trading as well. But there's different, different risk trade-off, risk to return. You have to kind of keep in mind. So I'm not going to call out any specific algorithms. I know deep learning is very popular, but to be honest, there are a lot of statistical analysis methods that are quite applicable to this. And do some Google searches. Find some basic technology you can reuse, because that's the number one thing: reuse, reuse, reuse. Okay, I mean it makes your life so much easier. It gets you actually trading much faster. And one of the things you're trying to achieve here is to develop a trading system that can remove the emotion from trading. Okay, if you turn this thing on and you're a basket case, that's definitely the wrong thing. Okay, we recommend kind of think on a longer term trading horizon. Okay, this is easier from a data and a cost, as well as less risk in terms of getting yourself kind of munched in like day trading. Okay. Algorithms, okay, and the time scale in which these can be trained on, biggie is the more rapidly you can train that, let's say on a daily basis, okay, the better, because algorithms go stale over time. Okay, if you have a great algorithm, people are going to copy it and be able to go with it, and you basically see market efficiency kind of working against you here. Also, structures that your algorithm picked up before change. Okay, so the shorter the time frame in which you can actually train and deploy your models, the better you are. Okay, and don't be afraid to break up the problem. Okay, too many people think that I'm going to build an algorithm that's going to do everything. Don't do that. Just have an idea of what the whole vision is of the system. Break down the problems in different models, and then go forward with that. That's a much better way of doing this. Okay, and don't try to maximize your returns. Don't try to be a Jim Simmons in one day. Okay, that's not going to happen. Definitely not practical. And to be honest, if you're making a system that's fully automated and it's making great returns, and you don't have to worry about it, there's nothing wrong with that. Okay, and keeping it simple. Okay, it's very easy to make it complex. The whole concept is complex, but start simple and add on complexity, especially if you're just starting. Data. Okay, so data is, of course, the fuel which drives this whole process. And kind of like the big categories that we found, kind of technical, fundamental, alternative. Okay, it's kind of a new up-and-coming, newish up-and-coming thing. Very expensive, though. Okay, ticker and fundamental, it's pretty easily accessible. Yahoo Finance, whatnot. Okay, alternative, very specialized, and extremely expensive, like $6,000 a month on some of these, expensive. Okay, and as you're making a trading system and it's automated, you definitely want to make sure you can access this from an API. So you got to, as you're building this algorithm or this system, you have to also take into account your team that you have to do this. Okay, if you're a trader, it doesn't necessarily have any technical skills. You need to kind of figure out what you can do with what you've got. Okay, if you can find a friend that's a developer, that's great. Use what technology is familiar with. Okay, don't try to use someone that's got some particular skill set, can access the data, okay, for one particular technology, but don't feel that you need to force it in one particular technology or another. Just use what you have experience. The problem is tough enough, so keeping it simple is part of this here. Cloud experience is, I think, really, really important here. More and more technologies are all being, cloud resident services. You really want to, kind of at least have some mind that this is what's going to happen. Okay. An algorithm programming experience. Okay. Really, it's not as straightforward as you think. Again, reuse is great here. Okay. So kind of an overview of what we kind of do, you know, from a basics perspective, you know, just so you can have an idea of, you know, kind of how our system works and how a simple approach of doing this. We're long-term trading focused. Okay, there's a lot of potential, you know, asymmetry that you can find in the market through this. We tried out day trading and actually had some great success, but it was pretty risky, data intensive, processing intensive. And when we were first starting out, we just decided it was just too much, you know, and not necessarily what we were doing good for our particular customer. Okay. You know, select companies that are good quality, but also of liquidity. Okay, even in small trading, liquidity can play a big role in performance of your stocks. So like, you know, playing with penny stocks, this is not a really liquid market, and you can get yourself bitten very badly, easily. Okay. We use technical indicators and, you know, compute, you know, momentum factors here. That's just us. We're looking at other stuff, but our current models use this, and it's, you know, a good way to make a reliable system right now, especially cheaply. We build models daily. This is kind of what we found to be a really great contributor in our overall performance. Okay, and we're building multiple models that have different kind of baskets, different factors that we're playing with. You know, a growth, value, US ETF, ESG. These, we find that we have a multiple, you know, kind of swords or arrows in our quiver in which we can use to be able to make good risk-adjusted returns over different market conditions. And this is another thing, you want to make strategies that are, you know, adaptable. And that's one of the big things that we've kind of been refining over the years. So our trading basics, the number one thing is everyone wants to get rich quick. Okay, you can do it, but you're also going to go poor very quick as well. Okay, especially if you're trying to do it over the long haul. Trying to make this work, you need to kind of dial back your expectations. Okay, it's great to make money, just profit is great. Okay. We found kind of like a basics from our algorithm is we first kind of screen for the different ETFs that our companies and ETFs we want to use. We always factor in liquidity because it's really made some nasty surprises in our tests before. We also like to have we have a long short strategy. Okay, that kind of allows us to shift how our money is based on the different market conditions. Like right now, okay, our model is saying we want to be short. Okay. So we're flat. Okay, so this is a really volatile market period. Have multiple tradable models. Okay, not all of your models will necessarily handle the current market conditions. Okay, so having these multiple models allows you to shift your allocation across these models. Okay, and then just simply go back to number one and repeat. Okay, this has worked great in being able to be adaptive and have long-term performance. And also just kind of something to think about. Look for market surprise if you're thinking about algorithms. There's amazing opportunities there. Okay, so my final thoughts, don't panic. Whatever you do, don't panic. Keep it simple, incrementally enhance your system. Have a holistic vision is great. Okay, kind of like what I just described, you know, have an understanding of what your system should be able to achieve, okay, and be able to kind of break down the problems you need to solve. Trade with real money as soon as possible. Don't just simply paper trade. No one cares about your paper trading results. Everyone cares about real money, even though they really care about hundreds of millions of dollars real money. But that's another story for another day. Manual trading is fine. You know, if your algorithm just tells you what you need to do, trade it, you know, manually. Okay. Be long-term focused. Okay, this is really important. I think especially for beginners, it's a lot easier, and there's actually a lot of opportunity there. Remove the emotion. You want an algorithm that removes your emotion from trading. Okay, so you can just, you know, sit on the beach drinking margaritas. And don't be afraid to fail. The faster you fail, okay, with less money, of course, the more you learn about how to actually improve your system. And profit's always good. Don't be afraid to, you know, feel that you didn't get every ounce of profit from a particular trade. That's not relevant. And thanks for your attention.
Okay, Bren. So thank you. It's been a really interesting presentation since we have understood the core of the main ideas when building an algorithm to invest. Now I have a question, Bren, that is, uh, you said previously that there's this, wait a sec, because I have to pause this. Okay. You were talking about different models. So you mentioned growth, you mentioned value. I mean, different models that are related with factors. So, but additionally, you said also that your model especially uses technical and quantitative indicators. So these two things, one thing is related with factors, fundamental factors. So is this the universe of stocks that you are selecting? So there are different universes that you select, and then you use them all together by using the AI with this technical and quantitative abilities. So what is the idea behind that?
So sure. So selecting what the universe of companies in which we build models on is able to allow us to apply longer term vision of what we think a particular stock is capable of or a quality. Okay. And our algorithm, being technical and momentum based, is more focused on executing where kind of like the more like near term focus on what you should be in at any one time. So you can kind of combine both your long term vision of what you think a basket of companies are capable of with the more near-term tactical execution with the algorithm. Okay, so it's the best of both worlds.
No, this is really interesting because I remember the other presentation that was on account of Wesley Gray, that is one of the investors that I like the most. This guy is a value-driven guy, but he's a quant investor. And he said something super interesting, that is combining value and momentum allows us to smooth the drawdowns, volatility, and stuff. So in this case, are you saying that we could use AI as a momentum indicator, as a momentum, and this is not a factor, but it's a momentum
selector.
Exactly, selector. So this is one idea that is on top of the value thing if you use the value universe, but you could use also growth universe or another type of universe, for instance, ETFs, as we do in Zonavalue. Is this right? This idea of combining both, you think, gives us more control about the volatility and the drawdowns and stuff?
Absolutely. And it's we see it in our performance of our models, and also just being able to allocate across models, that this is overall the allocation of selecting across models based on current technical indicators and momentum has allowed us to perform much better over the long term. So yes.
Well, this is awesome. By the way, this allocator is something that is super interesting because as an investor, I know, I wrap my mind to around this idea of, okay, I want to invest and I want to use this factor because I understand this factor. But I do know also that there are other factors, and it takes a long time to say, okay, I'm going to change a factor of investing, because in my case, my approach is super clear. And then I have these biases also, because what happens when, if you believe in value investing, for instance, that you want to buy the cheap stocks, the cheapest stocks, okay, this works in the long haul, but it gives you a lot of pain along the way. So and there's this thing that very often you see that another factors are working much better, are performing much better, but you are not, you refrain yourself from changing the factor since you don't understand perfectly the other factors. But there's another thing that you said, and let's see if I can put it properly. That is, okay, the AI can help you to use systematic models and to try to remove emotions. So in that case, is the agent who selects the factor, if you have different universe, is the agent who selects the factor depending on the current situation, the moment that you are getting through, and then it is going to help you to change the factor, not falling into emotions. Is this right?
Absolutely. And this actually was kind of part of our whole vision was that the market and the players in the market who have better or lesser performance changes over time, and we wanted some quantifiable way, which we can just simply automate this, and our actual results, I think, kind of speak for themselves. That it really helped kind of like, I see a significant difference in my value factor versus my growth factor here, or my US ETF, that I'm entering a really crazy time that, actually that one actually had much better strength from a trading perspective from what the agent said. So it would give me more confidence that if I were to allocate to that or increase allocation to that particular model, then I was going to be comfortable with trading it. It's great because it was much easier to make trade selections that way.
Well, this is interesting because your public strategy, it's you are killing it. This is clear. 40% this year. It's like, oh man, you are killing it. So it's awesome. But additionally, this model especially uses a rainbow of different ETFs. And I remember back in the day when we were studying the universes of stocks, we have the ETF, US ETF model and the Star Managers model. And I remember studying the universe and saying, oh, wow, this is awesome, because the ETFs per se, they have different factors. So the agent is cherry picking the ETFs depending on many things at a time. And when I see the portfolios and I say, oh man, this is super interesting, because now in this current situation, I have value ETFs, growth ETFs, I have this kind of technological ETFs, we have gold. So there are things that you say, oh, this makes all the same from a human brain. I would do something like that, no? Or maybe not, but the point is that I like it, as a human. So in this current situation, so what is what is happening in that? Because for me, it's quite weird that I see a portfolio in the Star Managers model, for instance, that is now, for example, in this time we are recording, that is combining commodities, gold, that is a way of making money, and at a time protecting yourself, hedging yourself with gold. At a time is buying value, it's buying growth, it's buying this kind of innovation, because there's the ARC ETFs inside. I don't know, it's super interesting, the portfolio. So what happens inside the brain of an AI machine to try to, to reflect and say, okay, this is a good portfolio. This is super crazy for me, man. It's super crazy.
Interestingly enough, the agent is more narrowly focused on each of the different companies in the basket, in the fund, in the model. And it actually doesn't even have any understanding of anything else outside of that, which is kind of crazy. And it's really kind of like the physics of the market are that the agent is it's always looking for risk-adjusted returns. So it's actually, kind of inherently looking for maximizing the Sharpe ratio, for instance. And actually, it's kind of a secret sauce. Don't tell anyone. It's actually deep in the actual brain of the model. Actually, has this financial heuristic in terms of performance. From the under the covers. But it actually is just kind of like the nature of the market and the way that each individual model tries to simulates how the world works. So we actually build an ensemble of agents for each particular company in a model, which is a collection of companies, and they run simulations. So we learn for the first 2 years, and then we actually live forward test on the last 3. It's basically what it learns on. It trains for about, I think 40 iterations is what each agent's trained on. So it's really sample efficient here. And it's using its temporal abstraction to kind of look into potential futures as it kind of goes through its reasoning process. And it kind of pulls these little skills it learns from its training, okay, and applies it, okay, technically it's called an option, okay, but it can reuse these little trading skills that it's used and on data that's never seen, and this allows it to be able to perform better in a kind of like changing environment that it's never seen and adapt well, okay, and we just kind of pull it together. So it's interesting how it's kind of been organic, but it's just something that just happened.
It's crazy. I see it, and I you know, it's like jaw dropping, you know.
I liked how it learned how to.
Sorry, come again.
One of the things that I thought was amazing, and I never programmed it into the system, was that the agent would learn that earnings dates, okay, were actually good times to get into certain positions, okay, and it would actually predictively be in a position before the actual earnings date. And when I first saw this, it was like, well, that's kind of an interesting coincidence. And I just saw one enter like just before it had an earnings date, and then it was, you know, there you go. I'm like, oh, that was kind of interesting, 27%. Like, holy cow! But then I identified, basically, it came down to is that the agent learned this behavior that getting into earnings was kind of for certain companies was actually very beneficial, and it was just kind of interesting how it learned that.
Well, it's awesome. It's jaw dropping, as I said, totally jaw dropping. Okay, so I have a last question. That is, so what's your take? What's your take on the? I mean, if we try to look ahead and say what's going to happen over the next 5 years, 10 years, and what I see is that in finance, in investing, so now there's a lot of people that is using AI. Maybe, I mean, there are different fields. They use it to execute orders. They use it to build models to invest. So there are many possibilities, but now I think this is, we are just in the beginning of this trend. So what's your take on the future of the AI investments?
Well, for AI investors who manually do this, I don't see a very good future in AI, in trading. Unless you're the technologist or the algorithm person, there's going to be less need for the traditional, day trader who's actually sitting there in front of, a bazillion screens looking at candlesticks. I think that what we're going to see is that the automation that AI can provide will be more broadly applied. So for instance, like right now, we manually kind of build our universes once the model goes, but we've already been testing, a next generation, which actually builds these for us automatically. And then based on the market conditions, it will just bring up these new models and say, okay, this is awesome. Okay, these models have kind of like are underperforming now. Let's select these new baskets and let's trade these. And I think that we're definitely going to increasingly see this automation. And yeah, it's going to be kind of like a nuclear war. Not nuclear war, but it's definitely going to be a war of algorithms, okay, that everyone's going to be fighting for some leverage. And it's only going to increase as we go forward. So it'll be interesting. So it may be harder to make outrageous returns, or maybe someone will, I think market surprise is probably like kind of like the last bastion of where algorithms are actually going to have a really hard time of being able to try to capture. Even humans can't do this. So
no, actually, I read a few weeks ago. I think there was an article super interesting where we saw that the hedge funds index, the average of the hedge funds index, I understand your point regarding the particular, so it's totally clear. But in the industry, the hedge funds, the ones that they were applying AI, they were beating up the average. So, and the other ones, they were just below the average. So this is quite interesting because this is a kind of an inflection point. I see an inflection point there. Now we are using, the world, the industry is using AI. And it's true that maybe for a particular, they need to use something. For instance, Zonavalue provides these models for particulars, but you can use funds or ETFs that they manage their investments through AI. So there are many possibilities as a particular investor. They can invest in these funds or these ETFs or whatever if they exist. So what I see is that the industry is giving it's trying to go forward and forward and forward. And what we see now currently is that these AI hedge funds are beating up the average. So this is something that very likely over the next years, this is gonna grow and grow and grow. And very likely we see a disruptive difference between the traditional way of investing and the let's say machine investing.
What you also have like the cost cost of maintaining one of these systems is going to drastically reduce over time. Okay, sure. It's going to become a commodity. The complexity, the barrier to entry of building and deploying these algorithms is going to also drastically reduce. Okay, so people are going to be able to pull from algorithms, mix and match way easier than they do right now. Because right now you need to have technical skills. In the future, it won't be so much, and that will be interesting. The kind of democratization, as it were.
Absolutely. Okay, Bren. Okay, so thank you, Bren. It's been a pleasure having you on here, and we are gonna see each other in the roundtable. So we will be discussing much more things about all of this. And nothing. Thank you, and I hope you have enjoyed also as much as I've done.
Thanks. It was great. Have a wonderful day.
Okay. Bye, Bren.
Bye.